So guys, what's next? What now we are going towards IFRS 16. Okay guys, we are going to start from IFRS 16. We are going to start the lease standard. First guys, listen carefully. Okay guys, previously guys, there was a standard called I-17. In I-17 guys, there was two types of accounting. The one accounting was lessees accounting and the other accounting was for lessor. So we have two types of accounts, lessors accounts and lessees accounts. In lessees accounts accounting guys, we divide the lease into finance lease and operating lease. In the same way, in lessors accounting guys, we divide the lease into finance lease and operating lease. Now guys, now the I-17 is no more. The I-17 has been revised by IFRS 16. If IFRS I-17 has been revised by IFRS 16, what does it mean? Now we again have accounting of both lessee accounting and lessor accounting. Guys, lessor accounting is same as it was in I-17. So it means IFRS 16 has obtained all the lessor accounting as it is from I-17. So I-17 lesser accounting and in IFRS 16 lesser accounting, they are the both same. So still the same accounting, operating lease, finance lease for lesser. But guys, for lessee, the accounting has been changed. So there is a change model for accounting. So we are going to study the changed accounting for lessee. Now guys, what to do, listen carefully. So we are going to do the lessee's accounting, how the lessee, the person who is getting asset on lease is going to treat the lease in its own accounting. So guys, listen carefully. What is the accounting model now? Guys, accounting model is in lessee's accounting for every lease, the lessee has to recognize an asset called right of use asset, and they have to recognize the liability called lease liability for every type of lease. So for lessee, there is no operating finance leases. For all kind of leases, they have to book an asset. It's called right of use asset, and they need to book a liability as well. So remember, all leases, no classification. Whenever you are doing lessee's accounting for a lease, you are going to book an asset called right of use asset and lease liability. Now guys, if we want to book the right to use asset, how we are going to initially measure that asset? The initial measurement of this asset is at cost. It is at cost guys. And how the cost is being calculated, this is important. How the cost is being calculated. So it has 5 components guys, and the 5 components will be combined together to get the cost. It is simple concept, okay? Just be with me to learn what is the cost concept. Listen carefully. Just assume that the asset has a cost of 200. Guys, if you'll pay to buy the asset, cash pay to buy the asset is 50. What is the liability? It means you acquired an asset who has a cost of 200. You just paid 50 to acquire that asset. So what is the liability, guys? What is the payable amount? It is simple. It is 150. If you have paid, that's brilliant. If you have paid 70, guys, then the liability will be 130. If you have paid 100, the liability will be 100. If you have paid 150, guys, 150, the liability will be 50. So the cash paid will reduce your liability. But the most important point is, if you'll combine them, the cash paid and lease liability, you will get asset cost, which is 200. Lease liability, cash paid, liability, cash paid, it will give you the asset cost. So this is the basic concept that obtained the lease lesser IFRS 16. If you want to book the assets value, just check what you have already paid and what is your liability. Then combine them, you'll get the asset cost. So this is the concept. So if you'll check, guys, what is the basic thing here? Look, the asset cost has some components. The first component is the lease liability plus payments made on or before commencement. So you are going to add them both. If you have already paid something and there is a liability, just assume you have a liability of 150 and you have paid 50 at commencement, then it means the asset cost is 200. If you have some initial direct cost on negotiation for lease on lease contracts, guys, then you are going to add that initial direct cost as well. Then we have a concept called dismantling, removing, registration. In IS 16, you are going to add the present value of dismantling, removing, and registration cost as well. It is the basic concept from IS 16. If you have any incentive received, guys, you are going to deduct the incentive received as well. Like if you have paid initial direct cost of 10 and the lessor is saying that I'm going to refund 2 out of this initial direct cost. We don't have dismantling, moving, registration, just cost assumed. So the cost will be 150 plus 50 less 10 plus 10 minus 20. It will give you, guys, 208. So the asset initially will be recognized at 208. So this is how you are going to calculate the cost. So the cost has 5 components, guys. The first component is, what is the first component, guys? The first component is lease liabilities. Second component is payments made on or before commencement. Second is third is initial direct cost, then present value of dismantling, moving, and registration. And the last one is incentives received, guys. Now, guys, what's next? If you have booked the asset, okay, what is payments made on or before commencement, guys? It will be included initial deposits called upfront amounts, down payments, initial deposits, because usually you pay before commencement. Commencement means when you acquire the asset for use, the date when you obtain the asset for use. So initial deposit and first installment in advance. Usually the first installment in advance is also being paid first installment in advance. These are the 2 payments that will fall under this category. Then we have initial direct cost. So this is the cost at which you need to recognize the asset, guys. Now, how to calculate the liability? It is simple. You are going to recognize the liability at present value of unpaid lease payments. So anything that is unpaid in future, you need to take the present value. And at which rate, guys, this is important, at interest rate implicit in a lease contract. Interest rate implicit in a lease contract. So interest rate implicit in a lease contract by lessor. The rate the lessor are charging you in a lease contract. But if this interest is not available, guys, then you can, if not available, you can use the incremental borrowing rate of lessee. Incremental borrowing rate of lessee. What does it mean, guys? It means if lessee need to borrow more money on the same terms, then what is the borrowing rate? So incremental borrowing rate of lessee. So you'll take the present value and you'll get the lease liability. Now, guys, how to measure subsequently the assets? How to measure the subsequently assets? It depends, guys. It's a subsequent measurement of assets. It depends. The right of use assets belongs to, either it belongs to IS 16 or it belongs to IS 40. How we can ascertain that it belongs to property, plant and equipment, or it belongs to investment property? If we are using that asset, it is IS 16. If we are letting it to others, or we have held that assets right to use asset for capital appreciation, it could fall under IS 40. Now guys, the subsequent measurement is with IS-16 and IS-40. If it is IS-16, we know we have two model. First model is cost model and the other model is revaluation model. So under IS-16, we will say that subsequently it could be carried at cost model or revaluation model. But if it is IS-40, guys, the cost model is there. So we'll apply the cost model if we are following cost model in IS-40, or we will follow the fair value model. So if IS-40 will follow these two models, if IS-16 will follow these two models. It means the subsequent measurement is entirely dependent on the relevant standard, either it's IS-40 or it's IS-16. Now we have another problem called depreciation period. How to depreciate these assets, guys? We'll take useful life of asset if asset will not be returned to the lessor. This is important. If the asset is not going to be returned to the lessor, then we'll take useful life. If we are going to return the asset to the lessor, in some lease contracts we usually return the asset to lessor, but in some lease contracts we don't return the asset to lessor. So we need to check whether we are going to return the asset to lessor or not. If we are going to return the asset to the lessor, we'll use the lower of useful life and lease term, because you will take the assets benefits for a lower period, either for useful life or lease term, if you are going to return the asset. If you are not going to return the asset, then it is a simple asset and you are going to depreciate over useful life. So over useful life or lower of useful life and lease term. Now guys, it was a subsequent measurement. Now guys, what's next? This is important. So guys, now, what about lease liability? Lease liability is going to recognize that present value of unpaid lease payments using interest rate implicit in a lease by lessor. If not available, we know what to use. It's an incremental borrowing rate. Now, guys, listen carefully. We need to book for every lease. For every lease, lessee need to book an asset and liability, but there are two exceptions as well. It means in these two exceptions, they don't need to book the assets and liabilities. And the exceptions are, guys, if lease is for less than 12 months, then there is no need to book the right of use asset and lease liability. And the second is lease of low value underlying asset. If the asset is not of high value, it is a low value underlying assets, it means you are acquiring a PC, a personal computer on a lease. It is a low value underlying asset, so there is no need to book the assets and liabilities. It's a small office furniture is also, but car cannot be low value underlying asset, guys. So if you are acquiring a vehicle on a lease, it will always be a high value underlying asset. So if you are in these two exceptions, there is no need to book the assets and liabilities. But if these exceptions are not applicable in your situations, then you need to book the assets and liabilities. Now, guys, how to do the accounting of this? Normally, we'll book the asset and liabilities, but what about this? Guys, we'll charge all the lease payments to P&L as a rental expense on straight line basis. So no asset, no liability, just book the just charge all the lease payments to P&L on a straight line basis. So this is the accounting, guys. You have formula how to calculate expense for 1 month, guys. You will take the total payments that you need to pay in a lease contract. If there is any incentive, you are going to deduct the incentive. Then you'll divide the lease term by months. You'll get 1 month expense, then you can charge the whole year expense. Now, the most important thing for me is sale and lease back. The most important thing for me is sale and lease back. But just to give you a thorough understanding of this standard, I'm going to give you an example of initial and subsequent measurement, guys. So you just need to pick your calculator so that you can solve the calculations. So give me the values, guys. Okay. So we just acquired an asset on a lease. So there is a lease contract. I'm telling you that there is a lease contract, guys. There is a lease contract. So the initial deposit is given. Initial deposit is $200. Installments are in arrears, guys, for 3 years. Just a 3 years contract for 3 years. So installment in arrears for 3 years. The values are all values are in $1,000,000. Okay, the installments are in arrears, and the installment per year installment is $50 million per year. Every year, and you need to pay 3 installments. Yeah, installment in arrears for 3 years. Installment 50 per year. So initial direct cost is also there. It was $10, and that's it, guys. So this is all about the lease contract. Now interest rate is given. It is 10%. Interest rate implicit in an interest rate. If not given, we'll use the incremental borrowing rate. So it is given 10%. So now we need to calculate how to do the lease contract accounting in lessee books. So lessee books, guys. Lessee books. So guys, we are going to recognize the asset and liability. So we know we have to book one asset and one liability. So one right to use asset. So we are going to book one right of use asset and one liability, and we know this. One right, one lease liability. Okay, guys. First, we'll need to calculate the lease liability. What you didn't pay yet, you need to calculate the present values. We are going to pay 50 in year 1 time, 50 in year 2 time, and 50 in year 3 time. These are the unpaid values. This is already paid. This is already incurred. So we have two values. Now we need to take the present value, guys, at 10%. So 1.10 raised to power minus 2. In the same way, 1.10 raised to power minus 3. Okay, year 1 is 45. We are keeping it simple. It is 45. For year 2, it is 41. And what about year 3? It is 37, guys. So this is total. What is the total, guys, now? It is 123, guys. So 123 is the total. This is the lease liability, guys. Now, guys, we need to book the assets. We know we need to book the asset at cost, and cost has components. The first component is lease liability, which is 123. The second component is initial deposit, which is 200, payments made on commencement. Third component is initial direct cost, and we don't have any other component. If we have incentive receipt, we are going to deduct that. So the asset cost is going to be 333, guys. So this is the asset, this is the liability. Now we are going to book an asset journal entry. Debit is right of use asset. You have right to use the plant or any asset. The value of this right is $333 millions. Credit is going to be a cash, and credit is your liability. And what we know, what is the lease liability? It is 123. So we are going to write 123. And what is cash paid, guys? This 200 is paid, this 10 is paid. So it is 210, guys. So this is the journal entry, guys, that we have recognized. Now we need to depreciate this. We know how to depreciate. I'm not going into the details. But now 123 is the liability, and you are going to pay an installment after 1 year. If you are paying the installment, guys, how much installment is there? 50. You need to divide this installment into principal and interest, because it has both components. It has principal as well as interest. So just multiply 123 into 10%. It will give you 12. So 12 is the interest out of 50, and the remaining 38 is your principal. Remaining 38 is your principal. Now the liability will reduce by 38. This will charge to P&L interest, and now liability will be 123 less 38. The new liability value, you will get the closing balance.